Welcome back to the deep dive. Today we are taking a really fascinating look at a company that has sort of managed to do the impossible.
You mean merging high-octane Silicon Valley growth with the, let's say, very conservative world of banking?
Exactly, and doing it all in the, notoriously volatile emerging markets of Latin America. We are diving deep into New Holdings, or Nubank, ticker NU.
Right, and this is such a critical deep dive because it's more than just another fintech success story. It's really a lesson in what you could call operational asymmetry.
Okay, so our mission today is what? To really get under the hood of that asymmetry.
That's it. We need to understand how this company, which, started with a simple purple credit card, scaled to 127 million customers.
Which is more than half the adult population of Brazil. That number is just staggering.
It is, and how they achieved a record return on equity of 31% in Q3 2025. And this is the key, how they do all of this while keeping their cost to serve just ridiculously low.
And we should be clear, we aren't just looking at the flashy headline numbers. We're digging into detailed analysis reports, Q3 2025 financials, and a lot of expert commentary to see if this whole thing is actually sustainable. It's the kind of company that's really starting to turn the heads of, let's call it the smart money. We know, for instance, that value titans like Howard Marks and Oaktree have been adding new to their 13F filings.
And that's a huge signal.
It is. It tells you that serious institutional investors are seeing long-term structural value here, not just some, flash in the pan.
That institutional validation is exactly why we need to look past the usual noise about LatAm volatility and really focus on the structural advantage they've built.
Okay, so let's set the stage with those recent results, just to ground everyone. New Holdings now serves a massive 127 million customers. That's across Brazil, Mexico, and Colombia.
And in Brazil, their core market, they are just utterly dominant, 110 million customers.
So that's over 60% adult population penetration.
Think about that for a second, the saturation. In their main market, they're not really a pure growth story anymore. They're shifting to become a dominant monetization platform.
And the engagement numbers back that up. They're maintaining an activity rate above 85% in Brazil. So these aren't just dormant accounts people opened once.
No, not at all. These are active daily users. And that efficiency, that engagement, it flows directly to the bottom line.
Which brings us to that record ROE, 31% in Q3 of 25.
Right. And this isn't just good for a growth company. That metric, return on equity, it matches or even beats many of the huge established global legacy banks, the ones that have been around for a century.
It tells us the unit economics are already there. They're mature and wildly profitable.
Exactly.
Okay, let's unpack that structural advantage. To understand how New gets to a 31% ROE, we have to go back in time. We have to look at what Brazilian banking used to be. What was the core problem New was trying to solve?
You really have to picture the situation, say, 10 or 15 years ago. Brazilian banking was a paradise for the banks.
And a total desert for the customers.
A total desert. Sources show the traditional banks were consistently enjoying ROEs north of 20%. I mean, huge margins. And they got them from what were essentially captive, completely underserved customers.
And they were captive because the experience was just awful, right? We're talking about massive fees, pricing you couldn't understand, absurd wait times.
And just extreme bureaucratic friction just to open an account or manage your money.
That friction is really the heart of the origin story, isn't it?
It is. It's precisely what motivated David Velez, the co-founder and CEO. The frustration was personal for him. He's Colombian, and when he moved to São Paulo, he tried to open a simple bank account.
And he ran right into that wall.
The classic LatAm banking experience. Locked glass doors, you have to go to a physical branch, a mountain of paperwork. And his whole mission just crystallized from that pain. Fight complexity, empower people.
But it wasn't just the paperwork. There was a physical infrastructure challenge in Latin America that's hard for people in, say, the US or Europe to really grasp.
That's a huge point. For millions of Brazilians, and Mexicans too, traditional banks just didn't exist nearby. People would have to travel 50, even 100 miles to get to a physical branch.
That's an immense logistical hurdle. It basically kept huge parts of the population unbanked or underbanked.
And the legacy banks kind of relied on that physical barrier. It was part of their moat.
So New's solution was, in hindsight, just genius in its simplicity.
Completely bypass it. Just ignore the physical infrastructure entirely. They started digitally native, built from the ground up for the smartphone.
And that changed everything.
It made all the difference. Suddenly, signing up for an account was instant. No travel. You could use the data on your phone to verify your identity. This let them onboard customers at a speed the legacy banks, with all their branches and ancient IT systems, just couldn't possibly compete with,
It just vaporized that physical friction.
which was the core pain point. And then they got a huge boost from some crucial regulatory tailwinds, especially in Brazil.
The Brazilian government was surprisingly forward-thinking on this.
They really were. They deserve a lot of credit. The key move was introducing the PIX system.
Okay, so PIX, this is the central bank managed real-time instant payment system. How exactly did that help new and, I guess, hurt the incumbents?
It hit two major things. First, customer acquisition cost, or CAC. PIX made transferring money between any bank totally seamless and totally free.
So once you downloaded the new app, you can immediately start using it, moving money in and out.
Instantly. It just lowered that barrier to entry to almost zero. And second, and this is critical, it absolutely gutted the traditional bank's revenue moat, which was built on interchange fees for things like TED and DOC transfers.
Those were the old, slow, expensive bank transfers.
Right. And PIX basically made those obsolete overnight. It turned a lucrative fee source for the old banks into a free utility, and New's low-cost model benefited from that immediately.
So the government basically acted as a catalyst for democratization, and New was just perfectly positioned because they didn't have any of those legacy fee businesses to protect.
Precisely. Then you add the demographic factor on top of that. Brazil has a very young, very adaptable population. Something like 45%, or 93 million people, are under 30.
Which is the perfect audience for a digital-first solution. They weren't, attached to their local bank branch.
Not at all. They were primed for a change. New's ability to target this massive tech-savvy group that was already living on their smartphones just meant their customer acquisition was inherently easier and way cheaper than trying to convince older, established customers to switch from the big five banks.
Okay, so that brings us to the core of the business. The engine that turns those 127 million customers into a 31% ROE powerhouse. And it all seems to start with this strategy of acquiring customers for next to nothing.
And then activating what they call the cross-sell flywheel.
Right.
The initial acquisition is almost a loss leader for New. They get you in the door with a transparent, no annual fee product. They aren't trying to squeeze money out of you on day one.
They're building trust, establishing habitual usage.
Exactly. The massive long-term value comes entirely from cross-selling you multiple, more profitable products down the line.
And what do the numbers say on that cross-sell? How quickly are customers adopting more products?
The stickiness is just phenomenal. The average active customer now uses just over 4 products, and most of that happens within the first 12 to 18 months.
And once you have your checking, your credit card, your savings, your investments, all in one seamless app that you trust.
It creates these really powerful structural soft switching costs. It's just a pain to leave.
Let's talk about the efficiency that makes this all possible. This is the number that always it blows my mind.
It should, because this is New's real asymmetric advantage. The whole operation is digital, very little human intervention. So the average cost to serve an active customer is only about 80 to 90 cents per month.
As of Q3 25, that's something like 85% lower than the traditional banks.
It's an incredible gap.
Wait, 90 cents to serve an active, engaged customer for a whole month? I mean, that's less than a single ATM fee at some banks. But doesn't that mean they're sacrificing customer service?
That's the key problem they had to solve, and the sources suggest they solved it with technology. New has invested hugely in their customer service architecture. A lot of it is chat-based support, AI-driven triage systems.
So they're using tech to handle the simple stuff.
Right. The goal is to let technology answer, say, 90% of the simple questions instantly. That frees up their human agents to handle only the really complex, high-stakes problems. And they focus on fixing those painful issues fast.
Which builds that habitual trust you mentioned.
Exactly.
So the super low cost is structural, but they maintain the quality through smart tech deployment. And that low cost just widens the profit gap as their average revenue per active customer. The ARPAC keeps climbing.
And ARPAC is the big signal of successful monetization. It hit $13.40 in Q3 25. That's up from $11 just 1 year before.
But the real power is in the cohort data, right? The compounding effect.
Absolutely. The cohort data is where you see the magic. Customers who have been with New for 8 years are now generating around $27.30 a month in revenue.
And what were they generating in their first year?
About $4.90 a month after their first 12 months.
Wow. So it's an exponential growth in value over time.
It proves the model is built for continuous, profitable cross-selling, not just, a splashy launch.
Let's dive into how they do that, the product evolution. They started with that revolutionary no annual fee credit card in Brazil.
Right, the foundation. But as they got bigger, they knew they had to go after the high-value customers. That led to the premium strategy, the Ultravioleta card.
Which is basically their version of an Amex Platinum, a targeted play.
A very deliberate, targeted play to copy that high-margin prestige model.
So what are the features that make Ultravioleta appeal to a wealthier Brazilian customer?
It's all about prestige and utility. It's a metal card, which sounds superficial, but it's a status symbol.
It matters.
It does. And more importantly, it bundles high-value travel perks, instant high-percentage cashback, and exclusive access, like their own private lounge at the São Paulo International Airport.
And how big is the monetization impact when they successfully pull in one of those high net worth individuals?
It's enormous. The sources we looked at suggest the ARPAC for this wealthier segment jumps to around $45 a month.
$45?
Yeah. And this segment is also highly creditworthy, so they're just exponentially more valuable than the mass market customer. It shows Nunaid can scale up the value chain, not just out.
And the product evolution goes way beyond just cards. What about New Invest, their investment platform? How does that fit into the flywheel?
New Invest is all about making investing ridiculously accessible. They let you start with as little as 1 Brazilian real in.
Which is, what, less than 20 US cents?
Exactly. And this is critical for keeping those high-value deposits on the platform. You link the savings account to the investment platform, and you just increase those soft switching costs even further.
And now they're moving aggressively into the B2B space, going after small and medium-sized businesses.
That's the next logical step. You have new and business credit cards, the deployment of Apple's tap-to-pay integration.
Which turns an iPhone into a payment terminal.
Right, so they're starting to court merchants. The goal is just product ubiquity. Consumer, investment, small business banking, all inside that one purple app. We even saw them experimenting with a cell phone service, NewCell, tying savings rates to your phone plan.
Okay, let's talk about the engine under the hood. Credit underwriting. This is so critical in a high-risk lending market. New often talks about using Gen AI.
Yeah, and that's where we need to apply a bit of healthy skepticism. While they're definitely using advanced techniques, sources suggest the models are more accurately described as standard neural networks' advanced decision trees.
The kind of stuff that's really good at processing tabular data.
Exactly. The real advantage isn't the buzzword Gen AI, it's the data they feed into those models.
So what kind of data is Nuyen using that a traditional bank might be missing?
Legacy banks rely heavily on traditional credit bureau scores, static financial history. No is leveraging behavioral data.
Like what?
Mobile usage patterns, how often you make payments, how quickly you pay back small amounts, even social graph analysis within their platform. This dynamic real-time data lets them adjust risk levels on the fly and approve loans for people that a traditional bank would just instantly reject because they don't have a formal credit history.
And looking long-term, what's the credit strategy? You mentioned a shift towards secured lending.
This is a really key sign of maturity. Unsecured lending, like credit cards, it generates massive margins but also carries huge default risk. The long-term goal is to grow secured loans.
Because they offer more stability.
More stability and better margins over the long run. So this means things like investment-backed loans, payroll-deducted loans, and, crucially, FGTS loans.
Okay, we have to unpack that acronym, FGTS. For listeners who aren't experts in Brazilian finance, what is that?
Right, good point. FGTS stands for Fundo de Garantia do Tempo de Serviço. The easiest way to think of it is as a mandatory employment benefit fund, kind of like a severance fund.
So your employer pays into it automatically?
Every month. And the government holds this money. You can only access it under specific conditions, like if you get laid off.
So how does New lend against that?
A lender like New can offer you a loan that is secured against your future access to that fund. If you, the borrower, default on the loan, the bank can recover the money directly from your FGTS account.
So it bypasses the whole messy collections process.
Completely. It turns a potentially high-risk consumer into a much, much safer lending prospect. It drastically lowers the default risk and gives the loan book way more stability. Shifting toward assets like FGTS is a necessary structural move to de-risk their balance sheet.
Okay, so we covered the structural advantages, the low cost, the data-driven risk models. Let's see how that all feeds into the headline financials.
Yeah, this is where it all comes together.
We mentioned the scale, but let's talk top-line growth. Total revenue grew by almost 50% year over year in 2024, hitting $11.5 billion. And Q3 of 25 was at $4.17 billion, a 42% year-wide growth rate.
I mean, that's growth you usually only see in pure tech SaaS companies, not in regulated banks.
Right.
And this is where that operational leverage really starts to shine. You see it in the efficiency ratio.
So that's operating costs divided by revenue.
Correct. And that ratio fell, it plummeted to 28.3% by Q2 of 2025. It was at 55% back in 2022.
A 28.3% efficiency ratio. So for every dollar they earn, less than 30 cents goes to keeping the lights on. That's truly world-class. It's almost impossible for a legacy bank with all its branches and old tech to even get close to that.
And it creates this enormous financial buffer. This buffer lets them offer lower fees and better rates to customers while at the same time maintaining super high profitability.
Which results in that net interest margin, or NIM, that reached 17 to 18% by 2024.
That NIM is just staggering.
Yeah, Brazilian legacy banks are usually around 8 or 9%. Why is Numa's double that?
Two big reasons. First, their cost of funding is low. They attract deposits with a great product, not just by offering the highest rate. And second, the product mix. Their portfolio is heavily weighted toward high-interest, high-spread products.
Credit cards, unsecured consumer loans.
Things that carry massive interest rates in Brazil. So the gap between what they pay for deposits and what they charge for loans is just immense.
But that high M, it immediately raises a red flag, right? Especially in a volatile market. Are they just making super risky loans that are eventually going to blow up?
Which brings us to the single most important metric for evaluating Nu's financial health. The risk-adjusted NIM.
RNIM.
Exactly. For anyone listening who's evaluating a bank in an emerging market, you have to focus on RA-NIM. It answers the one key question. Is the high interest rate you're charging enough to cover the high probability that your customer might default?
So it's simply the NIM after you subtract the expected credit losses.
That's it. And it reached 9.9% in Q3 of 25, up from 9.2% the quarter before.
And a rising RNIM is a very powerful signal.
A very powerful signal. It indicates that their underwriting models and their pricing are working. They're effectively covering their high credit risk and still making a very healthy profit. It proves their pricing is not just adequate, it's improving.
And we saw more evidence of that in the credit loss allowance expenses. They declined 7% quarter over quarter in Q3 25.
Right, and that stability isn't an accident. It comes from really disciplined balance sheet management. Let's look at their funding. Total deposits hit $38.8 billion. And crucially, they've been able to lower their cost of funding from 91% down to 89% of the interbank rate.
Which demonstrates that deposit stickiness. People are willing to accept a slightly lower rate for the convenience and trust of the new platform.
And that stable funding gives them enormous strategic flexibility. Their loan-to-deposit ratio, the LDR, was only 46% in Q3.
So they're holding a lot of dry powder. Why is keeping that ratio in the low 40s so important? Wouldn't they want to deploy more capital into high-interest loans to boost that ROE even faster?
That's the temptation. But it would also instantly crank up their risk profile. By keeping the LDR low, they preserve what you'd call optionality. Meaning if the macro risk conditions suddenly get better, or if a big competitor stumbles, Nu has this massive capacity to deploy capital very quickly and grab market share without having to scramble for expensive funding. It's a strategy built on resilience and patience.
We can't talk about resilience without confronting the elephant in the room, which is the massive macroeconomic headwind in Brazil.
It's still the single biggest risk. Brazil has been operating with persistently high interest rates, up to 14.25% in the sources we looked at.
And that kind of rate environment is just a killer for consumer lending.
It creates enormous pressure. It pushes up their own cost of debt, though their deposit base helps with that. It slows consumer spending. And most importantly, it significantly increases the probability of consumer defaults.
So the risk of recession, or even worse, stagflation.
Stagflation, low growth with high inflation, is a very likely scenario for 2025, maybe 2026.
And that kind of prolonged, nasty macro environment is the ultimate stress test for Nu's credit models.
It absolutely is. While they've done a great job managing delinquency rates so far, we haven't seen them operate through a truly severe and prolonged recession. Their 90-plus day non-performing loan ratio was 6.8% in Q3.
Which is manageable for now.
It's manageable and in line with what you'd expect for their product mix. But any sudden spike driven by mass job losses would immediately test that risk-adjusted NIM.
Which brings us full circle. That strategic shift to secured lending, Using things like FGTS isn't just about maturing as a company. It's a necessary hedge against that future macro volatility.
Exactly.
So moving beyond Brazil, we get to the next chapter, the growth story, international expansion. And Mexico has just exploded onto the scene as the new growth engine.
It really has.
What makes Mexico such a huge opportunity compared to Brazil?
Well, a few things. Mexico has a higher GDP per capita than Brazil, and its financial market is even less developed and digitized. Many of the products that are now standard in Brazil are brand new in Mexico, so there's just a massive runway for growth in a population of about 130 million people.
And the results have been stunning. They blew past 13 million customers in Q3 25, which is already 14% of the adult population. But that deposit growth figure,
The deposit growth is what really tells the story. It grew an astounding 438% year over year in 2024. That means Mexicans are trusting New with their core savings at an incredible rate.
but the single most important event for New's entire global story was what you called the deposit beta test in Mexico in Q2 of 2025. Tell us why that was so crucial.
Okay, this test fundamentally proved that New can earn, not just buy, customer loyalty internationally.
Oh, so?
When New launched in Mexico, they offered a very high promotional savings yield, around 15%, to get customers in the door fast. Then in Q2, they did something risky. They dramatically cut that yield to 11.5%, even while their competitors were still offering 13% or more.
And the result?
They retained over 90% of their customers, and balances continued to grow.
Wow. So that basically de-risks their entire international playbook.
It completely de-risks it. It means they don't have to get stuck in a permanent price war to keep customers. The cheapest capital in Latin America is that habitual trust inside the app, and that test proved that trust compounds faster than any promotional interest rate.
It proves the relationship is about the product, the UX, not just the highest rate.
That validation just dramatically strengthens the whole bull case for global expansion.
Okay, so next on the map is Colombia. Still very early stages there.
Very early. Colombia is way behind Brazil and Mexico in terms of financial digitalization. Something like 75% of Colombians still use cash for most of their transactions.
So a huge untapped market, but a much steeper hill to climb.
A steeper cultural and logistical challenge, for sure. They're already nearing 4 million customers there since launching in January of 24, but the main challenge has been regulatory.
More red tape than in Brazil.
Much more. Unlike Brazil, which was very open to fintech, Colombia has a slower, more complex approval process. It's just been harder to get products launched.
And that friction hits the bottom line.
It does. Colombia is a growth-first market right now, and the sources estimate it will be a drag on consolidated margins for a while, maybe 5 to 8 years before it's profitable.
Stepping back, we're also seeing this global ambition really accelerate beyond LatAm. The management's language has shifted from, a 5 to 10-year vision to talking about the world leagues in the next few years.
And the evidence for that is concrete. Noon has applied for a U.S. banking license.
But they're not trying to open a branch next to Chase in Manhattan, are they?
No. The strategy is highly targeted. They're aiming squarely at the massive and growing Latin population in the U.S.
So it's about connecting their existing customer base across borders.
Precisely. It lets them offer seamless money transfers, tapping into that huge remittance market. That's the money people send back home, which is valued at around $700 billion globally.
So they can capture a fee stream that currently goes to Western Union or traditional banks.
Exactly. It bridges the two regions for their most engaged customers and creates another powerful switching cost.
And any speculation on where they might go next in LatAm?
The chatter seems to point toward Argentina, especially with the recent, let's say, perceived stabilization of their economy, but that would be a much stiffer challenge.
Because it's Mercado Libre's home turf.
It is. In Argentina, New would be facing an already deeply entrenched digital ecosystem, not just a bunch of slow-moving legacy banks.
Which brings us perfectly to the competitive landscape. New has this incredible dominance, but financial products are, inherently easy to copy. What is their enduring moat?
Their moat really seems to be that combination of things. The first mover trust, that structural efficiency of a 90 cents cost to serve, and the unified platform that works across multiple countries.
But the competition is definitely heating up. Customer bundling is everything. If a rival can offer a better bundle, they can start to chip away at that 59% primary bank ratio New has.
For sure.
Let's break down the competition, starting with the biggest regional threat, Mercado Pago.
Mercado Pago is an ecosystem monster. They come from the Mercado Libre e-commerce platform, which gives them access to 61 million active fintech users. Their strength is their data moat.
Explain that. How does e-commerce data help you win in banking?
It's transformative. New uses behavioral and payment data. Mercado Pago knows exactly what you buy, how much you spend, how often you return things, your history as a buyer and a seller on their platform.
Which is incredibly valuable for underwriting loans.
Immensely valuable. It allows them to predict defaults with an accuracy that might even surpass news models. They could potentially have a lower NTL ratio and better margins on their lending, and they're not shy about it. They explicitly want to be the largest digital bank in LatAm.
So Mercado Pago attacks from the e-commerce side with proprietary shopping data new it can't get.
Exactly. Then you have the Brazil-focused players, like PicPay.
PicPay built their huge user base, over 60 million of them, on payments, on being a digital wallet.
Right. PicPay's strength is its payments ubiquity. They got profitable recently, so the model works. They are deeply entrenched in daily payments, paying your friends, your bills, small merchants. And they use that to cross-sell banking products.
If you're already opening the app 3 times a day, it's an easy step to become a banking client.
It's a very small step. And then finally, you have PagSeguro, or PagBank, which attacks from the merchant side.
They're profitable and totally dug in with small businesses.
They operate Brazil's largest payment acceptance network. Over 6 million merchants use their POS terminals. Their Moat is that terminal network. Every time you pay a small business with a PagSeguro machine, they capture that data.
They see the business's real-time cash flow, which is the holy grail for underwriting business loans.
Precisely. They convert those 6 million merchants and their employees into PagBank clients. It's a one-stop shop for business and personal banking. And that's a relationship and a revenue stream that New just doesn't have.
Which highlights New's most glaring weakness, right? Their absence in merchant services.
That is the big gap in their platform. By ceding the whole merchant acquiring and payment processing space to rivals like Mercado Pago and PagSeguro, New gives up a massive high-margin revenue source. And more importantly, they give up a crucial customer relationship and data source that their rivals are using to fuel their own lending platforms.
And then there's the over-reliance on Brazil.
It's still a huge concentration risk. Roughly 90% of their business is still in Brazil. If Brazil hits a severe bout of stagflation, 90% of New's business is under immediate pressure. Mercado Pago, with its broader Spanish-speaking footprint, is just more diversified.
And finally, we just have to acknowledge that LatAm consumers are, well, not always loyal.
Not at all. They're known to use multiple banking providers. While New has kept that primary banking account ratio around 59%, which is great, that number is constantly under threat. As rivals close the product gap, New has to keep innovating just to make sure customers don't move their core activity somewhere else.
So this deep dive has really shown us how New Holdings leveraged inefficiency and customer pain to build this hyper-efficient, highly profitable digital bank. The numbers are just, they're undeniable. A 31% ROE, a structural advantage built on a 90-cent cost to serve.
The analysis confirms it. And while the macro environment in Brazil is still the biggest risk, the validation points are huge. The success of that Mexico deposit test, for example, it significantly de-risks the entire model.
It proved they can build that habitual trust internationally.
Which dramatically strengthens the case for them becoming a truly global platform.
Yeah, for you, the listener, the key takeaways here are pretty clear. First, the new model works because of low friction and low cost. They turn cheap acquisition into high long-term ARPAC by relentlessly cross-selling 4 or more products.
Second, Mexico and Colombia are massive new growth runways. And the fact that they retain customers after cutting rates in Mexico, that just lowers the execution risk for every future country they enter.
And third, you have to monitor the balance sheet. Watch that shift to secured lending and always keep an eye on the risk-adjusted NIM. Those are the twin indicators of their credit quality and resilience.
The smart money, like the institutions you mentioned at the start, they're betting that this efficiency advantage is going to endure.
So here is the provocative thought we want to leave you with. New proved that its asymmetric cost structure lets it offer better rates and still turn a record profit. If the cheapest source of capital in Latin America is habitual customer trust inside an app, and New just proved that this trust compounds faster than any promotional interest rate, what does this imply for the future of traditional banking? Not just in LatAm, but globally. When a digital native platform reaches this kind of scale and operational quality, is the only real structural moat left in finance just customer trust? And if so, how quickly will the rest of the world's legacy banks collapse under the weight of their own inefficiency?